This is the Value Investor Podcast with Tracey. All things value, all the time.
Welcome back, value investors. So I've been watching a bunch of stocks that have had a troubling couple of months because I thought maybe we might be able to find some real value in these. And I named this podcast Pools, Boats, and RV Stocks, Values or Traps, because I wanted to take a look using our value or trap strategy that we've used, our way of trying to find value stocks that may appear to be cheap, but are they really, or are they traps? And I pulled out these three areas because these are big with consumers. Obviously, if you're going to buy a pool, a boat, or an RV, you don't necessarily need those items. And so they are more discretionary, and they have really seen the consumer pulling back on buying them over the last year or two even. And these were all big items during the pandemic. We had staycations. We wanted to stay away from people. We were hitting the road in an RV. And so they had huge sales going on during the pandemic, and that is mostly dried up now. But some of these stocks that I'm going to talk about today are trading at 5-year lows now. And so as a value investor, I am wondering, are there any deals here, or is it too soon to consider some of these? And all three of these companies that I'm going to talk about today have already reported earnings. So we have that out of the way, and we are getting like fresh updates from them about what they're seeing out there in the marketplace for their products and how the tariffs are impacting and what they're doing with pricing and things like that. And then we're going to do our usual analysis of, is it a value or is it a trap? And what is that analysis? If you're new here, we routinely do this with certain areas of industries like energy. We've done it with banks. I've done it a few times with kind of the retailers. This is the first time I've done kind of these discretionary items as a value or a trap. But remember, a lot of stocks can look like values because they've either sold off big, so you're thinking, oh, this must be cheap now, or they have a low PE. But a low PE doesn't necessarily mean they are a good value. They could be the trap side of things. And how do we determine if it's a trap or not? We go and we look at the earnings estimates. Are they rising? Are we expected to see earnings growth for next year? Because even as a value investor, sure, we want to get things cheap, but we also want to get things that businesses that are actually growing as well. That is where the sweet spot is for value investing, but it's also where it's the most difficult to find the stocks, because why would a stock that has a good outlook be cheap? Everybody would be buying it, right? But sometimes value stocks, the good ones, are still ignored by the street. They might be in an industry that is just out of favor. The street might just be slow in what is happening in that particular industry or with that company in terms of like a turnaround. It could be a small cap where few people, analysts are watching it. So we can find those kind of hidden gems out there. But in this case, all three of these stocks are fairly well known if you are into these kind of discretionary items, pools, boats, and RVs. And I'm not going to cover all of the companies in this category, just three, but it's going to give us some very good ideas. So what we want to look for is a cheap stock, but that's actually growing its earnings to be a true value and not on the trap side. So let's dive right in. Our first stock out the gate is Malibu Boats. Ticker M as in Mary, B as in boy, UU. So it's 4 letters, MBUU. And Malibu Boats makes Malibu boats. They also do, those are recreational power boats. They also do stern drive. with Cobalt. That's their brand there. They do saltwater fishing boats. So a lot on the boat side. This has been a challenging category. And even in this last earnings report, which was their fiscal first quarter 2026, they said that was still challenging market environment. And they're trying really, as they have been over the last couple of years, to keep the inventories aligned with the, what's out there at the dealers with actual demand and what they're producing. And it's taken them a couple of years to get in alignment on all of that. And it's still a challenge now. They also did talk about price increases in this quarter. And while they had sales up 13.5% and unit volumes were up 10.3%, last year was pretty dark at this time. And last year they had a lot lower shipments to the dealers because of the elevated dealer inventory. So that has worked its way a bit through. So the fact that they're now, sending more to the dealers doesn't necessarily mean that the overall business environment has improved dramatically. We just kind of think, for those of us not in this industry, oh, the sales are up, things must be getting better. But it's still very challenging on the backside with the inventory, and we're not seeing as much of the consumer demand. They did talk about how inflationary pressures pushed up costs, so that's not good. And then they did raise the prices. So again, sales being up, if you're raising your prices, you are going to get a bigger number there as well. So what is going on with their earnings estimates now that they did just report? So they have a market cap of $524 million. So they are the small cap. They are trading at 5-year lows now. 5 years, they are down 49.8% in the last 5 years, but the shares did peak in 2021. So they were on their way up at the end of 2020 because of the demand in boats during the pandemic. And then in early 2021, they peaked, and the shares have just been basically going down ever since. It's trying to find a bottom, and eventually it will. The market and the inventories will align, and then they're just waiting for the consumer demand to actually return. So that might take some time. But this year, the shares are down 23%. And over the last 5 years, like I said, 49.8%. So just looking at 2026, because they just entered into it, so that's fiscal 2026, they are looking now for $1.13. That is down 28.5% from last year when they made $1.58. But remember, those costs are rising for them as well. So that's playing a bit, and you can only do so many price increases without running off your customer as well. But we have two estimates that have been cut for this now fiscal 2026 in the last week since that earnings report. Two have been cut for next year as well. Although the analysts for now do see a rebound in earnings for next year up to $1.69, which would be up 49%. But normally I would maybe be looking at next year if this was on just a regular calendar year where they had just reported third quarter, but they just reported the first quarter of this fiscal year. So we are going to focus on this year. And I still see estimate cuts and the earnings still declining. So to me, even though the shares are down big, this is still has the trappiness feel. It probably hasn't bottomed yet. PE is at 24. So that's a bit stretched, but that's because the estimates, the earnings side is still on the decline. So the stock is falling. The estimates are still falling, though. So the PE does not appear real cheap right here. And it might not get down real cheap until those earnings start to turn around a bit, but they're not yet. Sales expected to be down 2.9% this year. That kind of reflects as well that we haven't really bottomed. And it is a Zacks number 5 strong sell right now with those earnings estimates being cut. So is this a value or is this a trap? It's pretty clear it has the trappy components right now. This is why I wanted to take a closer look at these stocks because, again, at 5-year lows, you are thinking, hey, maybe this is a deal, but not yet. Not yet. Discretionary is just really challenged right now. You don't have to buy that boat for the most part. So Malibu Boats, MBUU, is a trap right here. Okay, let's move on to RVs. And I'm going with Winnebago because they just reported earnings, although I think Thor is the other one that we often talk about, and they also have reported earnings. But I'm going with Winnebago this time. Ticker W as in Winnebago, GO. WGO is the ticker, and they do the RVs. They are not the one with Airstream, that is Thor, but they do Newmar, Grand Design, Winnebago. They also have a marine segment, so I didn't realize that when I chose them. So we're getting a little more with the boats. They do Chris Craft, which is premium boats, and then Barletta, which is pontoon boats. And as a Midwesterner, I'm especially fond of the pontoon boat, and I've been in many of them over my life. And so I feel like that might be a popular category for them. But we're seeing a lot of the same situation as we have been seeing with Malibu Boats, right? So this stock also did peak in early 2021 when everybody was buying those RVs during the pandemic. And then it hasn't been quite as steep of a drop for every year down. It did kind of pause in 22, 23, tried to rally a little bit at the beginning of 24, but now it's been down, and it was recently at 5-year lows earlier in 2025. It did have a little bit of a boost on this last quarterly earnings report because it wasn't as bad as it has been. And so some are maybe hoping that maybe the worst is over now. Maybe it might be safe to get in. It's not a 5. It's a Zacks number 3, which is the hold. And it does have A for value, A for growth, and an A overall VGM score, but it's got a D for momentum because it has been trading, near that 5-year low. So what does that mean? Winnebago, 5 years down 27.4% now, and year to date down 22.5%. But it has bounced off of on this last earnings report off of those recent lows. So it's got a little bit of a nice bounce. It has a forward P of 15.3, so it is a lot cheaper than Malibu, but it had been seeing some pretty serious declines in the earnings ahead of what it just reported. So let me go back. Even just looking on the front page of on Zacks.com on the quote page for Winnebago. So 2023, it had earnings decline of 44%. 2024, another 55.7% to earnings decline. 2025. So that's in because they must be on a fiscal year of some kind as well. It was down another 50%. And now suddenly in 2026, this is why the stock got a boost, it's now expected to be up 83% for this coming fiscal year. But it was after 3 years of some serious declines on the earnings. And taking a look, for last fiscal year, it made $1.67. It is expected to make $2.36 this year. That is a gain of 41% now. I'm not sure why it says 83 on the front page, but I'm going with what the detailed estimates say. It's maybe a little more updated. We do have 2 estimates higher in the last 30 days, but 2 are also lower. So the analysts were getting their estimates in order. But when I take a look at what happened with the estimates, It is expected to be higher. Now I can see why it's up a lot more on the quote page, because the current estimate is 236, but that's down in the last 30 days from 279. So the analysts have cut 40 cents or a little over 43 cents in the last 30 days to, right the ship after this last earnings report. And now they have a lot more insight into what's going on with the company. They did beat on earnings the last quarter, but it's not going to be quite as bullish of a year as what the analysts were originally thinking. So I'm not super enthused about the fact that they had to bring it down quite a bit in after that earnings report. And then we see for next year another gain of 29% up to 306. But considering they did, it appears, just start this year, or they're in the early stages of this fiscal year, I'm just going to look at this year like I did with Malibu Boats, and it still looks to be a struggle. But unlike Malibu Boats, it does look like maybe the worst is over from last year and that it's slowly starting to recover. The stock is fairly cheap on a PE basis at 15.3, as I said. It's not super dirt cheap here, but I'm just a little hesitant given, again, the challenging environment that we're seeing out there with these kind of discretionary items, and also with the tariffs still being in place on a lot of this. And even if they're manufacturing in the U.S., a lot of items are imported in, from even like fabrics or, leathers to steel, aluminum, things like that, that might be impacting on the overall costs as well. So I'm going to say that this one is much more of a little bit of the trappy side. I don't feel like everybody's thrown in the towel on it. Maybe before earnings they had. Now it's got a little bit of a boost. It's not as cheap. I would wait for a bigger pullback. And then I feel like I would still be on the sidelines, that it does have a little bit of the trappiness in those earnings estimates, but not as much as the Malibu Boats. So I'm still on the sidelines on Winnebago, on any of the RVs, and ticker is WGO on Winnebago. Okay, let's wrap it up with pools. And normally I could not talk about Pool Corp, ticker POOL, for years on the Value Investor podcast, because it was always too pricey. It was one of the beasts of growth stocks, and it was one of the best performing stocks of like the last 30 years, to be honest. And it always showed up on the lists until a couple of years ago. So it had a phenomenal run during the pandemic. It had record quarters. I thought nothing could defeat Pool Corp. We'd always want the pools. And then even if you weren't buying the pool, you had to maintain the pool. And so that they had a whole, service and repair business that was every year you're going to need service and repairs and things going on with the pool. And they also sell a lot of outdoor items, items for the pool, but also, like seating and tables and things like that, that also are just about the pool life, that lifestyle. But then the Fed tightened rates in 2022. A lot of people pulled back on buying pools because they're expensive, and now it costs more with the higher interest rates in the US to buy one, and the shares sold off. So Pool Corp actually peaked in late 2021 and then sold off with all the growth stocks in 22, and then kind of just stayed there for a couple of years until this year in 25, where it's been slowly, steadily kind of losing its hold on its narrow trading range. I've been watching Pool Corp this whole time because I do really love the company, and I just felt it needed to break down. That's what I call it, when it finally busts out of that narrow trading range. It wasn't cheap and the earnings were coming down. So why weren't the shares? Why were people holding on? With the hope that, maybe earnings are going to turn around. Well, they're not right now. And so the shares have finally broken down in the last couple of months. And now pool is down over the last 5 years. It's now at a 5-year low, down 34%. And then this year in 2025, it's down 24%. So for one of these stocks that has just been such a great growth name, I thought maybe there could be some value here now that it's breaking down. So let's find out. So it has a forward PE now of 23.7. That is under where it was during its big bullish push during the pandemic and even in the years before, where it was trading over 30 times, but you were okay with that because you were buying the growth. So for instance, in 2022, and they're on the calendar year. So in 2022, that is when the Fed was cutting the rates. So the shares did come down, but their business was still okay in 22. And they grew earnings 21%. They grew sales 16.7%. So that's where everybody was like, oh, it's fine. I'm paying 30 times for this because it's a beast. But then 23 sales declined 10.3% with earnings down 27. 24 sales down 4.2%, earnings down 17% last year. And now this year, sales down just 0.1, so mostly flat on the sales. Earnings only down 1.6, but still, is this a recovery? And then 26, which is coming quickly, sales expected to be up 3.3 with earnings up 6.2. So maybe there's a green shoot there, but I'm just looking on the quote page with the little chart, and now I'm going to the detailed estimates because they have already reported earnings as well. And what happened? They did beat, but only by a penny. So just taking a look at the estimates here for the full year. So we're looking for 1089. And as I said, that's just supposed to decline 1.6% from last year where they made 1107. So they're just kind of holding firm there. One estimate is higher in 30 days. 3 are lower, however. But looking at the changes to the estimates there, in the last 30 days, they've actually gone up a penny. So I guess that's from the beat. They beat by a penny and then they raised the full year. I don't know. But in 90 days, expected to make 1090, and now it's at 1089, only down a penny. So these estimate cuts aren't that concerning to me. Next year, we do have that 6% growth. They're looking for 1156. 2 are higher, only 1 lower. But 30 days ago, they were looking for 1157. So the analysts are getting it pretty right here. They do see some turnaround for next year. Will we get this? Maybe, because they are reporting, here late in the year. But I am looking at 26 now with this company and not 25 for my determination whether or not it's a value or a trap. Now, again, it's trading at 23 times. Is that cheap? Not particularly, but it's cheaper than what Pool Corp has been at. But I'm going to pay 23 times for my 6% earnings growth for next year. That's not cheap enough for me. So I'm not thinking this is a real value yet. And maybe that's why the shares have been down a number of sessions in a row and still haven't really bottomed here yet, because this stock is kind of in no man's land. It's not a growth stock right now. I do think it'll return to that once, it works through this downturn in consumer spending, and consumer will spend again and they will put in those pools. But I need to get this stock a lot cheaper to wait wait around for that to happen. And it has a PEG ratio of 3.5. That's not cheap either. And just looking in the financial overview, this is a number 3 hold, by the way, as well. That's, nothing wrong with the holds, but it just means sometimes it can indicate it's kind of in the no man's land thing as well. Price to sales is at 1.8, so that's pretty cheap. It's not classic value under 1 yet, but I am liking that it's at 1.8. Price to book is a little more pricey at 6.9, so almost 7 on the price to book. So it's not cheap enough for me, but this is why I continue to watch it. Is it a trap? No, but it's not a value. Does that make sense? It's not a value really here yet, but it's not trappy. But if you're a growth stock investor, you don't want it either because the growth isn't that great. Not yet. So you're just sitting on the sidelines. Everybody else is too. There's a lot of other cheaper stocks you can go for that, you can get genuinely cheap. And there's a lot of growth names, as we know, especially on the AI side, big time growth on the AI companies. And so there's no real reason I need to go into Pool Corp right here. So be patient as value investors. That's our key attribute. We have to wait on the sidelines. Warren Buffett is sitting with $385 billion, I think it is now. They are sitting at Berkshire Hathaway with all that cash, watching these same charts and things that we are, waiting to get some deals and waiting to get true values, not these traps on, and not getting in a little too early because you're thinking, oh, it's, trading at the 5-year lows. It must be cheap. But it's just really unwinding the big growth trade from the pandemic. And then it will get more attractive. And we are already seeing the street abandon all 3 of these stocks, really. That's why they're at 5-year lows. But I need them to abandon it a little bit more to get, I'm greedy. What can I say? I like to get as cheap as I can. And I think in this area, this consumer discretionary area, that we will be able to get it much cheaper still. So keep that in mind, and we'll keep watching these. And there are other companies, as I said, that are in these same categories, although I don't know another pool company that's, just pools. But we have Thor for the RVs. There are a couple other boat companies that are out there that are publicly traded. They're all kind of similarly situated, and they've all been saying the same things on their earnings reports. So be patient, and we will check in again, maybe early in 2026 in January, because we will be approaching the time of the year when people want to be buying some of these items. They are somewhat seasonal as well. You want to buy the pool, obviously. Actually, you probably want to buy it a couple of months ahead of the pool season, but you got to put it in the ground. So you're still going to need some good weather there. And same with the boats and even RVs. We want good weather to be driving around. So we'll check in. We'll check in on Malibu Boats, ticker MBUU, Winnebago, WGO, Pool Corp, POO. Thor is just THO, I believe. Yes, THO for Thor Industries. That's the one on RVs with the Airstream. And I'm going to click on it. Just curious what they are, a 4, which is the sell. And Malibu Boats was the 5. And then we had a 3 on everybody else. Everybody else was just a hold, Winnebago and Pool Corp. So watch those X ranks as well. They do change daily. And after the earnings reports, we're going to get a lot of changes as those analysts are adjusting the estimates now that they've got even more information in. And on some of these, watch what happens when they go to the big boat shows. There's a big RV show. A lot of times they'll talk with analysts during those to give them some insight and like what they're seeing from the dealers. And, they can give insight on consumer demand sometimes at those as well. So keep them on your watch list, as I will too. And I'm going to be watching a lot of these other kind of retail restaurants. A lot of them are getting beat up right now. They're not values yet to me, but they could be, depending on what happens over the next couple of months. But they're definitely out of favor, so they're falling in our wheelhouse. Maybe we could get some good names on, the restaurant side. We haven't talked about them in a while, or at least not the preeminent names. I don't think I've ever covered Chipotle on this podcast, other than to say, it's too pricey, because that has been one of the big growth players. And now I'm just looking right now, forward PE of 27 now on Chipotle, as the shares are at multi-year lows again, but it's traded above 40 times for like a decade or more, it seems. But maybe we'll get an actual value call on something like Chipotle. So be sure to tune in. Get us anywhere you can get podcasts. Definitely get us on our YouTube channel, on Zach's Podcasts on YouTube. It's a separate channel. Just subscribe over there, because I'm trying to cover all of these stocks here outside of the big ones like the Mag 7s. I am going to cover some hidden gems on the AI side, though, and try to see if we can find any kind of cheapness, or what are the cheapest on the AI infrastructure stocks. A lot of them have been reporting, so I'm kind of holding off on those. Also, I did a podcast with Nina Mishra on Berkshire Hathaway and Warren Buffett, so go check out her podcast. You can get it on our YouTube page. That's the ETF Spotlight. Check that one out as well. And as always, I'll be back next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.